Hello, I'm Thad Sykes, Divisional Vice President at NextGear Capital. Welcome to Financing Inventory for Growth, how to successfully manage a floor plan line of credit. Today we will discuss what a floor plan is, how a floor plan works, tips on lender compliance, and how to apply for a floor plan line of credit. Let's get started. Floor planning is a term used to describe the practice of inventory financing through a discretionary line of credit issued by a bank, finance company, or private entity. In other words, a floor plan provides additional capital with which you may buy and stock inventory to sell at your dealership. Traditional floor plans from floor plan specific lenders typically have four pricing characteristics. The first one you'll learn about is interest rate. Each line of credit will usually have a specified interest rate that is charged for the outstanding principal balance. The type of interest calculation that is used can be different from lender to lender. Next on the list is known as a term. These lines will require payments to be made towards the outstanding balance at certain maturity points. Much like a traditional consumer car payment, your floor plan will require that the loan balance be reduced over a period of time. The time between the flooring of a unit and the due date is commonly referred to as term. Most lenders will allow some flexibility in choosing what length of time is available to you between terms. After term, we move on to the floor plan fee. Traditional floor plan lenders will charge a transactional fee for each advance made against a piece of inventory. This fee is referred to as a floor plan fee. The amount of that fee can vary from lender to lender and is normally based on the lender's standard practices, the amount of risk they believe they are taking by extending the line of credit, and the length of time offered in the term. And finally, we have curtailment. At the end of each term, a payment is due to the lender. This payment is called a curtailment. In addition to having some flexibility in the length of time offered in each term, some lenders allow options as to how much of the principal balance of a unit is required to be paid down at the end of each term. It is good practice to choose a percentage based on the capital position of your dealership and the price range of the inventory you plan to stock using the line. One important thing to remember: floor plans do not provide the same length of time as a consumer loan before a loan payoff is due. Most floor plans provide for 90 to 180 days before a full payoff is due for any given unit. Now, allow me to share with you how a floor plan works. A floor plan transaction is really easy to follow. It mirrors the flow of any other inventory purchase you would normally make for your dealership. Most floor plan lenders will allow for inventory purchases from multiple types of seller. This seller could be an auction, another independent dealer, a wholesaler, or a franchise store. This purchase could even be from a consumer in the form of a direct purchase or a trade-in. Now, following your acquisition of the inventory, the deal is submitted to the floor plan lender for flooring. If the unit is purchased at auction, the auction will typically have an online interface they use to check your availability or how much room you have on your line of credit. Auction houses will want to be sure you have sufficient room on your line of credit to fit the purchase amount of the inventory. If you purchase from another dealer, you or the selling dealer would submit to the lender for flooring. In these instances, the lender will review the unit being purchased to ensure that the unit's value matches the amount you're requesting. Provided the lender approves the funding or advance, the amount is then dispersed either by ACH or check to your dealership or the seller. During the transaction, the seller is responsible for sending the title to the lender. Bear in mind that most lenders hold titles in-house for collateralization until the unit has been paid in full. Once a payoff has been made, your available balance is increased with the reduced loan balance and you're ready to floor another unit. A floor plan can be set up to house multiple loans according to your business needs. A typical floor plan can handle multiple flooring transactions in various stages of their life cycle, whether it be flooring or paying off at any given time. It's great to see you again. Now that I know you understand the basics, it's time to dive into floor plan compliance. Each floor plan lender will require that your dealership sign a promissory note, often referred to as your contract. Your contract will identify specific compliance requirements for your dealership. To keep your floor plan line open and ready to handle your transactions, you'll want to be sure your dealership remains compliant. Here are a few things to pay close attention to. First, your dealer's license must remain current. Allowing your license to expire will usually cause you to be non-compliant with your lender. Next, you must pay your lender promptly when a car is sold or disposed. Most often, lenders view the time the unit leaves the lot with no intention of coming back as the sale date or disposition date. Each lender will identify a specific timeline after the sale when you'll need to pay for the unit in full. Not paying a unit off when you sell it can certainly cause issues with your line of credit and can affect your decisions that the lender makes as your line of credit needs to grow. Not paying a unit off when you sell it can certainly cause issues with your line of credit and can affect decisions that your lender makes as your credit line needs evolve. Remember the curtailment payments we talked about earlier. Those need to be made on time. Most lenders will provide you with some type of online access for managing your payment due dates and making those payments. Some lenders now offer mobile applications that will allow you to do the same thing while you're on the go. Not paying your curtailment payments will certainly make you non-compliant with your lender. It's good practice to communicate with your lender if cash flow problems arise and you believe you're going to have a legitimate reason to be late. Communicating with the lender can help you remain compliant even when you are going to be late with your curtailment payment. Also of note is that most floor plan lenders will require that you allow them to visit your lot at regular intervals to inspect your inventory. This is called an audit. This lets the lender confirm that the collateral for the line of credit still exists. They'll want to see that the inventory is in sellable condition and is on your lot for sale. Due to the nature of selling used cars, most floor plan providers know that some inventory will be in stages of reconditioning. They know that you will need to send cars out for body work, oil changes, and tires. It's good practice to always know where your floor plan inventory is located and to have addresses and names of any shops handy when the auditor asks for it. Keeping your audits compliant and smooth for the lender is always a good way to show your lender your dealership's operation is well organized. Now, normally floor plan lenders will want a portion of your inventory insured against physical damage. This is definitely an area that serves to protect both your dealership and the lender in the event you experience an unforeseen loss due to damage of your inventory. Many lenders will supply you with their own insurance policy if you don't have one. A way you can save money is by using your own insurance agent to purchase a policy. It is always a good idea to compare these costs and make the best decision for your dealership. Okay, here's one last tip on compliance. Your floor plan lender will likely monitor your dealership credit and personal credit to be sure you don't have any new negative credit showing up during your relationship. From time to time, they may also search for liens or judgments. For this reason, it's important to stay current on all of your financial obligations in order to remain compliant with your lender. If something unexpected pops up, be sure to communicate with your lender so that they can give you the best advice to minimize any disruptions in your ability to use your line of credit. Now that we've talked about how a floor plan works and the keys to floor plan compliance, you've probably started to get an idea about whether having a floor plan makes sense for your dealership. There are some pieces to think about when you begin to look for or apply for a floor plan. At the top of the list should be how much of a line of credit you need. This is a serious question. After all, too much and you may over leverage your capital, but too little and it may not support your inventory needs. A good rule of thumb is to start with the supply you want to stock for a specific length of time. Whether you want to stock a 30-day supply, a 45-day supply, or a 60-day supply, there is a simple formula to decide how much capital you need. For a great starting point to determine your needs, multiply the number of units you would sell during that time period by your average wholesale cost. For example, let's say you typically stock a 45-day supply of units that average $5,000 wholesale, and you sell on average 20 units a month. Multiply 20 units per month by $5,000. This tells you your need is $100,000. Now, you may be wondering, where can you use the line of credit? It's important to know if the lender you decide to use is an accepted payment method at the purchasing venues you most often use. Some regional lenders are accepted locally. If you purchase from online auctions or auctions in another part of the country, you'll want to be sure your lender is also accepted there. If you most often acquire your inventory through trade-ins or purchases from other dealers, you'll want to ensure that your lender can handle those types of transactions. The next question I get asked is, can your interest rate, terms, and fees be customized? I mentioned earlier that terms, fees, and curtailments should match your business model and available capital. While some lenders have set programs, others will allow you to customize a plan just for your dealership. It's good practice to know and understand what your expected sales margins will be so you can figure out how much floor plan expense you can absorb in each unit. Knowing this will help you determine what you're willing to pay and what to request from your lender. You will have to recognize that the lending business is very much about risk versus reward in the eyes of the lender. For example, if you're a brand new business with limited capital, you can expect to pay a little bit more to balance the risk versus reward for the lender. Yet another question I hear is this: do lenders offer local representation? If you're the type of person that prefers someone you can get to know during your relationship with the lender, it will be important for you to know what they offer in terms of dealer representation. Some lenders provide brick and mortar locations with local representatives, while some offer centralized servicing and local reps that travel to your dealership. Whichever you prefer, it's important to communicate your needs with the lender. All of this ties into the overall viability of your operation. A thriving business should be building equity while reducing debt. A thriving dealer principal should be building net worth, not acquiring debt to keep their business above water. If your business isn't building and growing, then you probably shouldn't be seeking more floor plan dollars. More flooring won't turn around a failing business model. You would just be adding more fuel to the fire. Instead, focus on perfecting your operation. However, if your business is building equity and turning a profit, having some additional buying power can certainly help you shift into the next gear.